Hello, everyone. Welcome back to another lesson. If you're new to this channel, my name is Farhan and I help accounting students like you ace their exams. What we have got here today is a practice question for preparing an adjusted trial balance. I'm sure you're familiar with this topic and you have practiced similar questions in the past. Today, we will understand how to accurately and confidently prepare an adjusted trial balance if this pops up in your exam. All right. So you can see the question on the left-hand side of the screen, and on the right-hand side, we have all the workings, which I'll go through step by step. So with that being said, let's begin. The following balances were extracted from the books of Sydney Limited on 31 August 2024. So you can see we are given some balances for various accounts that we have got in our books on 31 August 2024. The following transactions happened in the month of September 2024 and were not recorded. So here we have got four transactions which took place in the month of September 2024 and we forgot to record them. All right. Now, the requirement in this question is to make sure that everything is recorded and we present them in an adjusted trial balance as of 30 September 2024. Okay. So what we have to do now is look into the workings on the right hand side. Let's first look into the transaction we have got here. Owner paid his personal insurance of $780 from the business bank account. This is actually referring to funds which have been withdrawn from the business bank account for personal use. The question clearly mentions personal insurance. Therefore, we can confidently say that this is drawings, specifically the drawings of funds available in your bank account. All right? So, if I was to journalize this, how would we do it? So we would journalize this by debiting the drawings account by 780 and crediting the cash at bank account by 780. Now, what's the logic here? Because funds have been withdrawn from the business bank account, the balance available in the cash at bank account is going to decrease. All right. So, because cash at bank is an asset account, if it decreases, we have to credit it to reflect that decrease. So that's why we are crediting the cash at bank by 780. At the same time, we know we have taken this money for personal use. Any drawings for personal use is what we always debited. So we are going to debit drawings by 780, which basically reflects the reduction in owner's equity or owner's capital available for investment within the business. Now, what's the logic of debiting drawings? When we have got capital available for investment in our business, we would always credit it because capital account by default is credited, which means when capital increases, we credit them. Now that we have made some drawings for personal use, we are actually looking into a reduction for the capital available for investment within the business. Therefore, capital, when it goes down, will have to be debited, but the specific term or the account that we have to reflect that reduction in owner's capital is the drawings account. So we are debiting the drawings account by 780. All right. Now, so here we have a new account, which is the drawings account, which if you check the old trial balance, it's not there. Okay. So in the old trial balance, the drawings account was not there, which means we will be adding this account when we prepare our adjusted trial balance formally. Okay. So at this moment, the cash at bank is decreasing by 780. Therefore, the original balance that we had at 31 August 2024 for cash at bank, which was $30,000, will now be decreased by 780. Okay? All right. So let's now look into the second transaction. Received an invoice for purchase of furniture at $1,420. All right. When we are receiving an invoice, it actually means that we haven't paid for this item yet. Okay? We had got an invoice and we can see the amount in this invoice that we are required to pay from the people whom we bought this item from. In this case, we had purchased a furniture which costed us $1,420 and we ended up receiving an invoice. We can also say that this is the same thing as furniture purchased on credit and we are yet to pay for this amount, okay? So if I want to journalize this, how would I do it? Definitely, we have bought furniture, which represents a non-current asset that we have purchased. And when assets increase in our business, we always debit them. So we will debit the furniture account by $1,420. At the same time, because we have received an invoice which clearly indicates that we have bought this furniture on credit and we are yet to make a payment, we have a liability, which is a present obligation. And all liabilities by default are credited. That's why we will credit the liability account, specifically the account for other payables, by $1,420. Now you might wonder, why is it other payables and not trade payables? Trade payables are the credit suppliers of the business. These are the suppliers or the people from whom we buy inventory on credit, and that inventory is what we resell later at a profit. So we haven't purchased inventory in this case. So that's why we cannot use the word trade, all right? Trade payables are those people from whom you buy inventory on credit, and those inventory are mainly purchased so that you can sell them later to your own customers, okay? In this case, we have bought a non-current asset, which is not obviously an inventory, and therefore the correct account to use is the account for other payables. Now, you must be always aware, and if you check the old trial balance, not the trial balance actually, all the balances that we were given on 31 August 2024, we didn't really have the account for other payables. We do have trade payables, but now that we have got a new account for other payables, make sure to add this when you prepare the adjusted trial balance formally, okay? So now we have two new accounts, the first one being drawings, and the second one being the other payables, okay? All right, so we understand our furniture is increasing by $1,420, which is what we need to add to the original amount for furniture, which was $8,500. So now we will add an additional $1,420, okay? All right. So when we are ready, now we can move to transaction number 3. So transaction number 3, salaries and commission income are overstated by $560. All right. So we know that we have overstated the salaries expense and commission income by $560. And now we have to reduce the salaries expense and at the same time reduce the commission income that we have already in the books. When you want to increase an expense, we debit them. And expense accounts by default are always debited, which also means that when they increase, we debit them. Now that we have to reduce this expense account, specifically the account for salaries expense, we have to credit them to reflect that reduction, all right? And the amount here is $560. Commission income account by default is a credit account. In fact, all income account by default are credit accounts, which means when they increase, we always credit them. Now that we have to reduce the commission income due to the overstatement which we have originally made, we now have to reduce that commission income by debiting it. So that's why we debit the commission income by $560. Okay? Now, how do we reflect this in the balances we have already got? So we have to first reduce the commission income by $560. So we originally had a balance of $2,600 for commission income. All right. Now we will reduce it by $560. So $2,600 minus $560. And for salaries, we originally had a balance of $15,000, and now we will reduce $560 from there as well. Okay. All right. So let's look into the last transaction that we have got. Credit sales of $5,570. The cost of sales was $2,900. Now, every time you make a sale on credit, it's the same journal entry, which you can memorize or understand. Sales revenue by default is always credited. So we have already made some sales here, which is why we are crediting sales revenue by $5,570. And because we have made this sale on credit, we have a current asset account that's coming into existence, which is the account of trade receivables. Who are the trade receivables? Trade receivables are the credit customers of the business. These are the people to whom we have sold on credit. Okay? So we have some kind of economic benefit attached to these people, and that's why these are asset accounts. Okay? So we will debit the trade receivables by 5,570 and credit the sales revenue by 5,570. Okay? So basically your assets are going up due to the increase in trade receivables, and at the same time your revenue is going up due to the increase in the sales revenue. Okay? Now every time you make a sale, always remember that we also have another pair of journal entry which has to do with the cost of the item which we have sold. Now, you know how a business works. We buy the item at a cheaper price and then we end up selling it for a markup to our customers. So obviously there's a cost that we need to reflect in our books and the cost of the inventory which we need to show that we have sold. All right. Now, inventory is a current asset for the business because we have sold this inventory which costed us $2,900 originally when we bought it from a supplier. And inventory being a current asset now is being reduced in value. When assets go down, we have to credit to reflect that reduction. So we are crediting inventory by $2,900. At the same time, why are we crediting inventory by $2,900? Because we have sold it and we have an expense account which we will debit. And the expense account is the cost of sales account. So cost of sales is an expense account, and by default, all expenses are debited. When they are increased, they're also debited. Okay, so cost of sales are debited by $2,900, and the inventory account is credited by $2,900. Okay, so when we debit cost of sales by $2,900, our expenses are increased by $2,900, and when we credit the inventory account by $2,900, our current assets are going down by $2,900. So we have 4 lines of entry which we need to reflect in the balances we were originally given. First of all, we know that trade receivables, which are our assets, are increasing by 5,570. So in the account for trade receivables, which you can see on the left-hand side, all right, I'll just add 5,570 to 15,110. And also in the account for sales revenue, I'll add 5,570 to the old balance of 60,820. Next, for the cost of sales, which is an expense account that increased by 2,900, I'll add 2,900 to the original balance of 17,800. And the inventory account, which we credited, means the asset account decreasing by 2,900. We will subtract 2,900 from the original balance of 8,700. Okay. All right. So now that we have all the workings and the relevant adjustments in place, it's time to prepare the adjusted trial balance. So I'm not writing the details that we need to write at the beginning. Adjusted trial balance of Sydney Limited as of 30 September 2024. You can do that. But here I have a format or the outline already prepared for the adjusted trial balance. So we're just going to fill in the numbers based on who's debited and who's credited. Okay. So to begin with, we have got capital. Capital, always remember, by default is a credit account. Okay. Assets by default are always debited, which means when they increase, we debit them. Liabilities by default are always credited, which means when they increase, we credit them. And capital by default is always credited, which means when they increase, we credit them. So to begin with, we have got $48,690, which we will show on the credit column. There's obviously no adjustment in this case. Next, we have got the sales revenue, and by default, all revenues when they increase are credited. So we have got an adjustment here, which is to add 5,570 to 60,820. I'm just going to bring my calculator up. So it's 666,390 for sales revenue. And like we have discussed, revenue by default is always credited, which means we will show them on the credit side. Next, we have got the cost of sales, which is an expense account. And by default, all expenses are debited in nature. So cost of sales is 70,800 plus an additional 2,900, which is the adjustment we have done for the last transaction. And that gives us an amount of $20,700, which we will include on the debit side simply because it is an expense. Next, we've got the insurance, which is an expense account. No adjustments needed, so we'll just simply show it on the debit side, $13,800. Then we have got the accumulated depreciation of furniture, which is $2,000. Accumulated depreciation in itself is a contra asset account. What do we understand by a contra asset account? A contra asset account records the reduction for a relevant non-current asset account. And the relevant non-current asset in this case is the furniture account. Now, furniture in itself is an asset account, as we understand, which means when the asset increases, we will debit them. But the accumulated depreciation is mainly there to record all the depreciation that we incur by utilizing the furniture in our business. So whatever reduction will take place for using the furniture, we store it in a separate account known as the accumulated depreciation of furniture account, which is a contra asset account. And by default, all contra asset accounts must have a credit balance. Okay. So accumulated depreciation of furniture is to be shown on the credit side, the amount of 2,000. The same thing applies for the accumulated depreciation of machinery, which is 9,000. You can see I didn't write the full form. I just write accum debt because I didn't have enough space, but make sure to write the full form and all the words when you prepare this in your exams, okay? Next, we've got the cash at bank, which is obviously an asset account because it refers to the funds available in our bank account. And there is an adjustment, which is to subtract the $780 from 13,000. So let's do that. 13,000 minus 780, which gives us 12,220. And because cash at bank is an asset account, obviously the balance will be on the debit side. Next, we've got the furniture, where we are adding the purchase of new furniture of $1,420. So originally the balance was 8,500. Now we are adding 1,420. So let's do that. So 8,500 plus 1,420 gives us 9,920. And furniture, being an asset account, will be shown on the debit side. Machinery is an asset account, obviously, so we will also include that on the debit side, 73,000. Then we have got inventory, which is a current asset account, also to be debited, but we have got some adjustments here, which is 8,700 minus 2,900. Basically, we are subtracting 2,900 because based on the last transaction, if you recall, we have sold some inventory which had an original cost of 2,900, which we paid to our supplier to buy it. So that's 5,800 as the final balance after the subtraction of 2,900. And we will show that on the debit side. Next, we have got the trade receivables. And we know we sold the inventory on credit, which increases our asset balance or the amount that our credit customers owe us. So originally it was 15,110. Now we are adding an additional 5,570, which gives us $20,680 as the total amount. And because trade receivables are assets, definitely they will be shown on the debit side. Okay. Next, we've got the trade payables. There are no adjustments for trade payables, but trade payables refer to the credit suppliers of the business, and these are the people to whom we have a present obligation because we have bought inventory on credit from them. Therefore, they are our liabilities, and by default, all liabilities are shown on the credit side. So trade payables of 20,800 will be shown on the credit side. All right. Next, we've got the long-term borrowing, which is a non-current liability. The reason this is a non-current liability is because it's a long-term borrowing, which means we can repay it over multiple years, okay? And because this is a liability, definitely it's shown on the credit side, 20,500. Then we have got the commission income, which is 2,600 minus 560, because originally we overstated this amount, so now we are reducing it. So 2,600 minus 560 gives us how much? Gives us 2,040. And commission income, being an income account, must be shown on the credit side because all income account by default is credited. Basically, the exact opposite of expenses, which by default are always debited. Okay? Next, we've got the allowance for impairment of trade receivables. Allowance for impairment of trade receivables is a contra asset account. Why is this a contra asset account? The definition of contra asset is that it's an account which records the reduction for a relevant non-current asset, a relevant asset. And the asset in this case is the trade receivables, which are the credit customers of the business. So when we sell to our customers on credit, there are some possibilities that we may not be able to recover 100% of the amount that we have sold to them originally on credit. Okay, so there could be some possibility that we will have some losses, and those losses that we expect are stored in a separate account, which is the contra asset account known as the allowance for impairment account. Okay, because this is a contra asset account, by default it should always have a credit balance, because assets generally have a debit balance, and contra asset basically records the reduction for assets. Okay, so 500 here will be shown on the credit side. Then we have got salaries of 15,000 minus 560, which we had overstated. Now we are taking it off. So 15,000 minus 560. So 15,000 minus 560. So 15,000 take away 560 gives us 14,440. Where should we record this? On the debit or credit side? Of course, on the debit side, because it is an expense account. Okay. Then we will show the two new accounts which we have got. Let's not forget those. We've got drawings, and then we've got other payables. We understand that drawings by default are always debited, and the logic is that drawings reflects a reduction in owner's equity or owner's capital. Capital, as we know, are always credited. So now that we have a reduction in capital, which is stored in a drawings account, it is obviously to be debited. And the amount for drawings was 780 based on what we have done for the first transaction. And then we have got other payables for the credit purchase of furniture, which was 1,420. And because it's a payable, it is obviously a liability, which we are showing on the credit column. Okay. All right. I'll just erase this. Now what we have to do now, so we just simply take our calculator and add everything on the debit side. Then we add everything on the credit side, and let's hope it's a perfect match. All right, so I'll just check this. Let's see. So the totals, what we get for the debit column is 171,340, and for the credit column we also get 171,340. I believe so. You should all get the same amount. Okay. All right. So 171,340 is the total for both of the columns. All right. So that's it for today's lesson. If you found value in this content, and if it really helped you, make sure to drop a like and subscribe to this channel, and check the top link in the description to book a free Zoom call with me and discuss your tutoring requirements, so we can help you prepare and ace your exams that are taking place at the end of the year. So with that being said, I'll conclude today's lesson, and I'll see you in the next one.